Hello everyone, my name is David Varsimashvili. Are compliance regulations becoming so complex that they are killing the businesses? This compliance is no longer a side function. It's a core operational requirement. AML assessment is no longer just a regulatory requirement. It's a fundamental necessity to safeguard organizations from financial, legal, and reputational risks. Do sanctions work or not? The answer is both yes and no.
Hello and welcome everyone to the Soltesz Institute webinar series, where we are fighting for an ethical and transparent payment and banking industry. We believe that everybody should have the relevant knowledge to make the decisions which affects their funds, understand how the money is being kept by who, and how money moves internationally, as well as how banks think. So we bring you industry experts from all over the world to digest in a little bit more about certain topics and areas. And this week brought you an absolutely amazing expert, Thomas, who is going to tell you everything about stablecoins, what are their functions, how are they used in the banking world, and how does it affect our day-to-day life. So today's our topic is about stablecoins and how does it affect our everyday life. And welcome you, Thomas, and thank you so much for accepting this webinar invitation. And thank you for sharing your wisdom with us. Please tell us a bit more about yourself and how did you become a stablecoin expert? What exactly that you do and what are you going to explain us today?
Good afternoon, Victoria, and thank you for having me. So I'm working in a consortium of blockchain companies called Terranode. It's a consortium of more than 15 companies, and I'm in charge of the fintech department. So within the fintech department, we have 4 companies active in different fields related to finance. And one of the fields is the stablecoin field. What brought me to the stablecoin area is that if we go back to the original vision of the blockchain technology, it was to bring digital cash system to life. And along the way and along the years, we had different forms of money, and stablecoins are currently very, very trendy. And the reason behind that is that stablecoins are generally issued by private companies, and the private sectors has to be innovative, especially in the technological side. So that's why stablecoin came like an evidence in the overall payment system because of the innovative capabilities of the private sector.
Right. And I think even though that people think that, stable coins, what's so difficult about it? It's 1-to-1 to dollar, 1-to-1 to euro or any other currency. It's just crypto. There are so many other layers that we are going to get into today. So I'm really, really excited to have an amazing expert like yourself to give us a bit more understanding about how stable coins are being used. Obviously, what was the history? How did we end up here where we are today when we are talking about fintechs and the usage of the stablecoin? So I think it's going to be a very, very exciting couple of minutes that we will spend together. As usual, we collected some questions from the audience before, so we are going through those questions and picking your brain about all of those important information. But if anyone would like to ask any further questions, I would like to encourage that please do so through the live airing of this webinar, or even after. Just send us your comments, your questions, and even after this webinar, we are very happy to reply to those, of course, because we want everybody to be adequately educated about the subject. So let's see the first question, which is immediately starting with, what do we have as so many digital currencies? And all of these digital currencies, is it not just the same thing? Crypto is a crypto. So tell us a bit more about why we have so many, what are those so many currencies, and how are they different from each other?
Yeah, so that's a very good question. So I think we need also to acknowledge that this technology is quite new. It was invented in 2008 with the publication of the Bitcoin white paper. If we go back to the history of different technology, internet, for instance, had been invented in 1980 and has been adopted in 2015. So we had to wait 20 or 30 years for this technology to be adopted. So 15 years is not a lot. So that's also the reason why at the beginning of the technology, a lot of experimentation and explorations occurred, and especially on the field of digital currencies. So to answer the question, we need to go back to the definition of what is a currency and what is money. There are three main characteristics of money, especially in the economical field. It's a mean of exchange, store of value, and accounting system. And in order for a money to be defined as a money, we need to have fulfilled these three criteria. So that's why when we mention cryptocurrencies like Bitcoin, ETH, and the lot of the well-known cryptocurrencies, there will never be an accounting system, in a sense that governments will never allow financial statements of companies to be expressed in cryptocurrencies. It will always be a government issue or central bank issue currency acting as an accounting system. So in its pure definition, a cryptocurrency is not a currency. So that's the initial objective of a cryptocurrency was just to be able to pay the transaction fees or the gas, if you take the example of Ethereum. The thing that's because Bitcoin Core followed a digital gold strategy, so they position Bitcoin as a store of value and really to be a digital gold. A lot of people thought that the cryptocurrencies, they would also be in the store of value, which is the case for Bitcoin, but none of them will be an accounting system. Accounting system, there are other forms of digital currencies for that. The first one is CBDC. The second one is stablecoin. We can also argue that commercial bank deposit token might also be a form of digital currencies. But basically, it will always be denominated into government-issued currencies such as euro, dollar, and so on, using as an underlying technology the blockchain technology, and depending on the protocol. So we have different forms of money because the blockchain sector has been exploring for the last 15 years and went to at this exact moment where now we, because of the regulation, we acknowledge that the forms of digital currencies should be aligned with the different regulatory frameworks, and stablecoin, CBDC, and commercial bank deposit token will be digital currencies because they will fulfill the three criteria: store value, mean of exchange, and accounting system. The cryptocurrencies will not be digital currencies in the sense that there will never be an accounting system. It doesn't mean that they are not useful, because they are very useful for companies to be able to access a blockchain network and to use it by paying the transaction fees to miners or validators. But in a pure sense, in an economical sense, cryptocurrencies are not purely a digital form of currencies.
So if I understand it correctly, let's say that there is another value expression in the world and people are still trading with it. Let's say it's gold, for example. So if I have some gold and I'm giving it to my friend in return for some products or services, my friend cannot really declare the value in gold in the financial statement. So my friend needs to submit this to the tax office, pay the relevant taxes, make sure that, the government is understanding that he's earning gold, but only in the value of the currency of his reporting system, right? So I suspect that the same happens in the cryptocurrency as well. So in this way, there are still currencies where you can actually do the submission and it's used as a basis for the tax reporting. And then there is another category, which could be a gold or, a loaf of bread or anything that you use it as exchange to other values, including the cryptocurrencies as well. Do I get it right?
Yeah. You totally got it right. Indeed, you can report the value of your cryptocurrencies because cryptocurrencies are also a store of value. So if we take and Bitcoin Core is the perfect example, right? They position the strategy of Bitcoin as being a digital gold, so as primary criteria, the store of value. If you have some Bitcoin in your treasury, you can report the value of your overall Bitcoin as an asset in your financial statements, which is totally fine. But the financial statements themselves, they will be always expressed in dollar, euro, or Swiss franc, depending on the jurisdiction that you are in. Governments will never let privately issue digital money or digital currencies, and Libra and Diem is a good example of that, right? Because this was a kind of stablecoin project with a basket of underlying assets issued and managed by private companies. But the reality is that the governments and central bank will never let such a project happen because they don't want to lose the power and the monetary policy system that the different CBDC, for instance, play a crucial role in.
Right. But let's see, how does it affect me as a normal average person on the street, right? Okay, I acknowledge that there are some cryptocurrencies, there are stable coins. I think this is what the next question is really about, that how do you see the impact of stable coins in our day-to-day life, and why does it matter to me as a normal average person? Because I'm thinking about it. If I'm using euro or dollar, I can see it on the bank. I kind of trust the bank, right? But if I'm buying crypto, I have to go through very cumbersome checks and I have to open the account and there are so much fees, and somehow the stable coin is not really one-to-one. I'm always losing something on the exchange. So what's in it for me? Why would I use it as a person?
Yeah. So in our day-to-day life, we will use stable coins as we use euro or dollar today. The only difference, it will be just a digital form of euro and dollar, but the end user will not notice that it's a stable coin. It will be just a digital form of euro or dollar. The difference is between a stable coin and the fiat money that we have today is that it's cheaper, faster, and smarter, right? So cheap, fast, and smart. Smart because the main objective of the blockchain technology is that you can add some kind of rules indirectly embedded into money. And these kind of rules, and that's one of the main added value, the blockchain technology. And on the payment system, it's not a very innovative industry. If we take the underlying technology of the international payment system, the infrastructure is quite outdated. If we take the example of SWIFT, which was invented in the 1970s, it's a very old technology. So blockchain is here to bring more innovation to the international payment system, and by setting up some kind of rules that you can encode and embed directly into money. So for instance, you will be able to have some rules where if you buy a car, you can block the money without the need of a dedicated escrow account. And when you see the car, you test it and everything is okay, then you can unlock the money. Or you can add some kind of loyalty programs by preserving the privacy of user, because there won't be any specific company who will handle the loyalty program. The privacy will be preserved by the blockchain technology. So this is the kind of added value for the end user. For the end user, he will not accept the additional features allowed by stablecoin. It will simply be euro, but a smarter euro. And in terms of speed and cost, especially for cross-border payments, not the regional cross-border payment, because we already have very cheap or even free international payments in some regional areas, such as SEPA in Europe. But if you send money to another country, you will be able to decrease the fees from 6.4%, which is the international average according to the World Bank, to maybe 1% or 0.5%, right, in terms of fees. So this is the kind of added value also for the end user, especially on the remittance area, to improve the speed, because you will not rely on only the weekly days, but you will be able to send money 24/7, but also in terms of cost, because you will be able to reduce the cost from 6.4% to maybe 1% in the future.
Right. As far as I understand that, every time that we open an account or we want to send money abroad, there are banks who are checking if those transactions are legit. I am indeed paying for things that I will receive, right? So no one can scam anyone. I paid my taxes on that amount of money that I'm trying to input in the financial system. So what I can see is that, yes, it's very difficult sometimes to move money internationally, and sometimes it's very slow, but there is a reason, because banks need to check where the money comes from. Is it from legit sources? We are keeping the financial system alive and the trust is intact. So what do you think? What is the dangers now that there is something which looks like money, acts like money, you can use it as money, but there are kind of less checks or different checks, it's faster, it's cheaper. Is it not a massive threat to the existing financial system? And if it is, how comes that we are using it? And where is this, common denominator area when you see that, yes, we can take advantage of all of these added values of the stablecoin, but we still need to enforce all of those rules which are in place today in order to maintain a healthy society, and in order to make sure that, no one is creating their way out of the system and, just send something in stablecoin, which is outside of the financial system. No one sees it, so I don't have to declare it. How do you see that? What are the dangers of using these stablecoins or any other forms of assets which are outside of the current financial system?
So, of course, the dangers for the end user is that end user can lose their money. That's the main danger, right? And in the past, because stablecoins are not new, right? For the last 7 years, maybe, you had a lot of different forms of stablecoin, algorithmic stablecoin backed by different underlying assets, and so on and so on. The main advancements within the stablecoin area is the regulation. And the last part of your question was outside the current financial system. It should not be outside. If you have a stablecoin which is outside the financial system, don't transact with it, because that's the main danger, right? The stablecoin should be within the financial systems and align with the current regulation. And the European Union and the US played, especially the European Union, because the MiCA regulation has tackled the stablecoin parts and a certain amount of ruling and governing the stablecoin use case, and same for the Genius Act in the US. So for me, one of the main difference between today and in the past is stablecoins are now part of a regulatory framework, and this regulatory framework protects the end user of any danger of losing their money. If we take the example of MiCA, but also in the US is the same, it has to be one-to-one backed by fiat. If you have $1 in stablecoin, you should have $1 deposited in the bank account, or you should have short-term assets such as government bonds and so on. So these are very liquid assets guaranteeing the value of a stablecoin. So this is for me one, and obviously you have a lot of different additional rules in terms of KYC, AML, and so on to protect the user and to make sure that they will not be able to lose any money. So for me, this is the main difference between today and during the last years is the regulatory framework. And the main regional areas, such as the US and Europe, has come with a proper regulatory framework, allowing the adoption of a stablecoin by protecting the end user for losing their money.
Quick question. If there are some monetary policies by the central banks to print money, keep money back, control the inflation with different decisions, But then comes something which is one-to-one to the traditional money. How they manage to maintain the current supply, and also because the whole financial system is actually based on credit, right? I'm investing. I'm giving 10 euros to the bank as a deposit. The bank is declaring it as their own money and lending out tenfold or sometimes, 15 times more, creating more value in the system. But if we have the stable coin, which is now backed physically by the issuance, so if I'm issuing 20 stable coin, I have to have 20 traditional money worth of amount safeguarded in an account. In your opinion, is it not going to affect any kind of monetary policies of releasing more money in the financial system or keeping it back? How does it affect the inflation? Do you see with stable coins we are then see the end of this credit system? How do you see this?
Yeah. So the monetary policy from the central bank are handled through what we call central bank digital currency, or CBDC. So this is the way a central bank can issue money digitally using another form of digital currencies called CBDC. So this is the way a central bank will still have the ability to control the creation of money. Stablecoin, there is no creation of money with stablecoins because, as I mentioned earlier, there is no lending on top of stablecoins deposited at the bank, because if you deposit $1 at the bank, you just have the dollar in stablecoins. So you don't have creation of money. It's not like a bank, because banks are able, when they receive some deposit, to create some loans and to create additional money, and the central bank can control the creation of the monetary mass by a certain number of ratios called Basel ratios, with the ability for banks to not overpass a certain amounts of lending that banks would be able to create. So, but stablecoins are outside this kind of ratio, and actually it's more even safer than depositing your money at the bank, because the banks, you don't rely on the bank because you rely on the bank because you deposit your fiat at the bank, but there is no money creation. It's one-to-one back, so it's kind of safe. If you want to have your stablecoin back, you can just take it back from the bank, and that's it. You don't rely on an external entity such as a bank and their lending policy, because the stablecoin itself is not part of the overall money creation process.
So if stable coins are issued by private companies, even though that they are regulated, and CBDCs are issued by the central bank, but effectively they are basically the similar things, then this means that private companies can also be part of the central bank's plan of the money supply and the money control. And if not, then what's the main difference between these CBDCs and the stable coins?
Yeah, so well, the first difference is who is issuing a CBDC and who is issuing a stablecoin, right? And so on the CBDC side, the central bank issues the CBDC. On the stablecoin side, it's a private company, because stablecoins are also called privately issued digital money. But as mentioned, when they issue the stablecoin, they don't create new money. They just transform a deposit at the bank into a digital version. That's it. So there is no involvement of private companies in the monetary policy. On the CBDC side, yes, there is an involvement there is creation of money, but it's handled directly by the central bank themselves. Private companies are not involved in the creation of a CBDC. But the CBDCs themselves, so the digital version of money created by the central bank, might be handled by, you will have some banks, retail bank, dealing with some kind of CBDC, and you can imagine that retail banks will have some reserve of CBDC in their balance sheet to also be able to issue other form of money. The industry is currently exploring some commercial bank deposit token. We will see later, but retail banks are also involved in stablecoin projects, issuing some stablecoin projects. So to conclude on that question, it's important to understand that private companies are not involved in creating money. It's just transforming the fiat money deposited at the bank into a digital version of this fiat money. That's it. And central bank will still have the control of the money creation, because by issuing what we call CBDC, central bank digital currency, they are able to control and to act on the monetary policy.
Have we seen this before with the e-money institutions? Because the e-money technically is electronic money, right? So if there is an e-money institution who is getting the deposit from the client, keeping it in a safeguarded account, issuing electronic money, which is basically one-to-one to the deposit, in this way they are not creating new money, so that's why they are not a bank, but they are issuing electronic money. So is it the same with the stablecoin? It's just called differently because they are running on different systems?
Yeah, exactly. It's a good summary. But actually, that's because sometimes in industry, we use new terms and nobody understands these new terms. And I don't think it's pretty good in terms of adoption, but it's exactly what you just said, right? Stablecoins are just a new iteration with additional capabilities such as speed, cost, and additional features, right? This is what stablecoin is about. There is nothing new. I mean, the only thing really new with stablecoins is are the additional capabilities allowed by the blockchain, the use of the blockchain technology. That's it. But the rest, the creation, the money system, and the regulation aligned with this use case is not new. The stablecoin at the end are just a digital version of money with additional capabilities, and that's it. Yeah.
All right. So if it's so good, and you mentioned it's cheaper and it's safer and it's easier, why is it not everywhere, right? I mean, yes, I can see that it's coming up, but still average people might not know about it. Not every financial institution is using it. So what are the main challenges of the adoption of these stable coins? Why are we not all using it and, just ditch all the electronic money completely and focus on nothing as the stable coin?
Yeah, I think we kind of answered this question a little bit earlier. For me, the main challenge in terms of adoption is trust. Trust by the end users. And in order to have trust, you need to have a form of money within and inside the existing financial system. If you have money outside the financial system, you cannot have trust. And that's also the reason why, digital currencies or using blockchain technology have not been adopted yet, is that you had cryptocurrencies which were completely outside the financial system. People thought it was money, but it's not. And you cannot have trust. And people start to think that they would be able to pay in their day-to-day life in Bitcoin. It's not true, simply because of the volatility of a cryptocurrency. And again, because you will never have any governments letting prices or an entire national pricing policy, but also accounting systems expressed in cryptocurrencies. So for me, the main challenges are trust, and the solution for these challenges is the regulation. And I think this is what is crucial for the adoption of stablecoins. First is MiCA and the Genius Act in the US. I think these regulatory frameworks will play a crucial role in the adoption of stablecoins. So to answer your question, why we thought the stablecoins are not adopted, I think simply because there was a lack of a clear regulatory framework expressing exactly what are the rules that private companies have to follow, issue a stablecoin, and for the end user to be protected, right? Because at the end, this is what regulation should be about. The regulation should be here to create a solid regulatory framework protecting the end user for any uses of digital currencies.
Hello everyone, my name is Viktoria Soltesz and I'm the founder of the Soltesz Institute. Startups fail. And if they fail, most probably they are failing because they don't have the thought out and proper channels for payments and banking.
Hello everyone, my name is David Vartimashvili. Compliance is no longer a side function. It's a core operational requirement.
Hey, welcome everybody. I'm Marcia Klinget-Smith. Instant payments is transforming the way money moves all across the globe, across all the different industries.
And I think the regulation is not exactly the same everywhere because there are still countries which are banning cryptocurrency completely, stablecoin or not. But there are certain countries where, Europe, we have MiCA, which is really regulating it to the core. But then in the US, we've got different regulation, which is different than MiCA. So maybe that could be a bit of confusing, of course, to the end user, for sure, but also for financial institutions that, okay, today I'm allowed to do that, but tomorrow I might not be allowed to do that. So maybe that could hinder mass adoption, that there is this big question mark, big regulatory changes all the time. What do you think about it? Will we see any regulatory harmony anytime soon? Or because it's new, because not that many people know about it, it's still going to be completely segregated of how countries are dealing with that on an individual level?
Yeah. I think it will take some time to really have some homogeneity in terms of regulatory frameworks. The reality is that MiCA acts as a de facto foundational layer, and we see it in different other jurisdictions. They take into account a large majority of the MiCA regulatory framework. Doesn't mean that they are not obliged to and they don't have to. MiCA is currently acting as like a kind of reference for different jurisdictions. So you will have, I guess, some differences between the different regulatory frameworks, which is a reality. Obviously, so it means that for private companies it will be more complicated to really go international, even if I guess that if you have a license in Europe, for instance, and you comply to one of the most rigorous regulatory framework, then if you go to another jurisdiction, because first the other jurisdiction takes into account some of the MiCA principles, it will be quick for you to have a license in another country as well. So for private company, yes, there might be some, and especially at the beginning, right? Because at the beginning, different jurisdictions create their own regulatory framework. But along the way, first, at the end, it's not rocket science, right? But basically, what MiCA and also the Genius Act do is that for some of the use case, they just refer to the previous regulations, such as MiFID. So at the end, the blockchain technology is just an evolution of existing use cases. And as evolution of existing use cases, sometimes you don't have to invent the wheel. So sometimes some of the use cases are already covered by previous regulation, which is fine. Some of the use cases are new, and for the new use cases, the regulators, they don't want to create a very complicated framework. They want to make sure that the framework is good enough for the underlying technology, and that's why at some point we're going to have some kind of alignments between the regulatory frameworks of the different jurisdictions.
Yeah, and until then, we've got a massive opportunity for regulatory arbitrage, right? It's here, it's allowed, it's there, no. So, cross-border transactions, it gets really, really complicated. What do you think? What kind of role education plays in this? Whose responsibility to educate not only the market, but the end users as well, the financial institutions? Or the market thinks that, all right, I'm regulating what I need to, and the guys will figure it all out. Because to be honest with you, I'm myself a payment and banking expert, but there are so many layers of even today's conversation, which is quite eye-opening for me. So who should take responsibility over the education, which then results in mass adoption? And who should actually educate everyone about the benefits and the complexities of this issue?
Yeah, so I would say that whoever benefits for the adoption of the technology, right? So my view is that private companies should also play a role in educating the end user, because they will benefit from the output of this education. So on our side, we are involved in a lot of educational programs. It might be in universities, but also in professional organizations, to educate the end user, educate also the regulator. And the different regulators around the world are very keen to organize some working groups, so educational sessions to make sure that both private and public sectors are aligned, because that's also what innovation is about, is that we are building along the way, and we are building and we have to educate at the same time, right? This is unfortunately for the first movers, that's the role that first movers have to play, because we have to do two different things, and it requires a lot of work, but that's also part of the job, right? If you want a new technology to get adopted, you also need to invest part of your time in educational objectives.
Well, that's so true. And at the end of the day, businesses have the responsibility as well, because if someone is handling your funds, then you should figure out that how is that money being handled? How is it being stored? And what are the new applications of this innovation and all that new fintech industry? So yeah, I think that's why it's important that we are talking about these things, and opening up the platform and opportunity for people to ask the questions and educate themselves about it, because the innovation is already here. If you snooze, you lose. You don't know how to apply that to your own company. You will be the one who is missing out, and everybody should be at the forefront of the technological innovations and adopt as much as they can, right? Because it's there, either you pay attention to it or not. So yeah, I think that's why we are doing all of these webinars to raise awareness and put the attention where it really should be, around how money moves and obviously what are the latest innovations. Let's see again a bit more on what's the future. Are there any alternatives to stable coins which we can expect in the future, or it's enough innovation? What do you think? What are we going to see with the quantum computing, if it's coming? What do we see about AI? Do they even affect anything around stable coins? What's happening with the crypto market as a whole? Is blockchain still a thing, or there is a new platform, new innovation coming out? So is there going to be any alternative to stable coins, or this is what we have, good enough? Obviously, CBDCs are creeping in, but that's what we see on the market as far as we know so far.
So yeah, I think if we try to draw a landscape of the different forms of digital money, you have CBDC, CBDT, so for commercial bank deposit token, stablecoin. Then you have cryptocurrencies, right? So today, depending on the jurisdictions, depending on the wording, you might have different wordings. But high level, these are different forms of digital currencies. Even if the cryptocurrencies themselves are not purely digital money, but the alternative would be commercial bank deposit token or CBDC. When I say alternative, I consider an alternative when the digital currencies fulfill the three criteria of definition of the economical definition of money, which is store of value, mean of exchange, and a counting system. If a digital currency doesn't fit and is not aligned with these criteria, I don't consider it as pure alternatives, simply because you might be able to store value, Bitcoin Core, for instance. You might be able to exchange like any form of cryptocurrencies, but you will not be able to express the financial statements of your company in this form of digital currency. So I would say that these are the alternatives: CBDC, CBDT, stablecoin as pure digital currencies, and then obviously you will still have cryptocurrencies. But cryptocurrencies, I think we also need to go back on why the cryptocurrencies exist, and the reason why a cryptocurrency exists should be simply to allow companies to access a blockchain network and to pay the network, to use this network, right? This is the primary use case of cryptocurrencies. Again, the problem is that because the Bitcoin Core team has decided to change the strategy of Bitcoin and become a store of value, and following the strategy of digital gold, a lot of people thought that the entire cryptocurrency landscape should be considered as a store of value and as the speculative investment, but that was not the initial vision. It didn't mean that it's wrong, that's fine. You can speculate in cryptocurrencies, but in the future, I would see first that you will have cryptocurrencies used by companies to use the network for real-world use cases. You will still have some kind of speculation, which is fine because speculation brings liquidity. So it will allow companies to access cryptocurrencies more easily to then be able to pay the network and use the network. And then in our day-to-day life, the layer that we will see will be either stablecoin CBDC or CBDC, but the stablecoin should be largely used in our day-to-day life simply because you will have a lot of different entities issuing their own stablecoin and allowing the stablecoin to be more adopted.
Right. So if I understand also correctly, then, cryptocurrencies are very volatile. So stable coins are, of course, one-to-one to the traditional fiat currencies. So their representation on the blockchain, therefore, shall be different, right? Because I can mine cryptocurrency. It is the value of the blockchain on its own. And that's why it's volatile. And that's why it's not tied to any real life asset, right? But when we are talking about tokenized assets or stable coin, it is actually just a representation of a value in the system, but it's not the value of the system itself, if you know what I mean. Am I correct in this way? Can you actually mine stable coin or there is a blockchain which is running on its own cryptocurrency and the stable coin is just a reference to a value? How can we imagine this?
Yeah. So it's a very good question. So at the end, stablecoin is just an asset-backed token. What we call asset-backed token is a token representing an underlying asset. In the case of a stablecoin, is just a token representing as the underlying asset fiat money. That's it. It's an asset-backed token representing the value of a fiat currencies. That's it. Then the other kind of token, like cryptocurrencies, it depends on the jurisdictions. Because I'm in Switzerland, and in Switzerland, FINMA, the financial regulatory body, issued quite early some kind of guidelines in terms of how do we define and treat the different stablecoin, and they came up with three main categories like payment, asset-backed, and utility tokens. Utility tokens are basically all the cryptocurrencies, maybe not all of them, but cryptocurrencies in the sense that you are rewarded as a miner to participate to a specific network by receiving as a reward a currency, right? This cryptocurrency should be used by companies to use the network. That's why they are called utilities. So this is the main difference between cryptocurrencies that should be used as a utility token to use the network and to pay the transaction fees, compared to a stablecoin, which is an asset-backed token. And as an asset-backed token, it is aligned with a specific regulatory framework, so MiCA and Genius Act, because they represent an underlying asset, which is a fiat currency.
All right. It's much better now. It's in terms of understanding, it's much clearer that, even though it's a cryptocurrency, it's not really a cryptocurrency of itself. It's like a token which is representing an asset. That it makes me wonder that how about the self-executing smart contracts that we just didn't mention until now. One of the beauty of the blockchain that it can be connected to self-executing smart contracts, which does not need any human intervention. So you can program it into the money that if something happens, then the money is going to get released, or if one condition applies, then something happens. So we see that with cryptocurrencies, of course. Then I guess that we see with a stablecoin. And we also see that with CBDCs, right? So in this way, that could be the main differentiation of the traditional money. And if it's so, are we even using it? Where are the technology that we are programming these self-executing smart contracts into the token itself?
Yeah, so what we discussed a little bit earlier about what is the difference between stablecoin and digital money or fiat money. We mentioned cost, speed, and additional features. And the additional features are, from a technical perspective, largely due to smart contract capabilities. When we mentioned that we set up some kind of rules into money, under the hood, for some of the cryptocurrencies, we use smart contracts. So we use conditional features. And as I mentioned with the example of I'm going to buy an old car, but I will block the money until I see the car, I test the car, and I validate the fact that I'm going to buy the car. Under the hood is a smart contract. A smart contract is just programming capabilities, conditional logic that you can set up. Depending on the protocol, you can directly set up using core programming language capabilities, but for some of the protocol, you use smart contract. And these rules that you can add on top of money under the hood use conditional logic, and that's why we always mention that stable coins, but also blockchain technology will make the money smarter, because under the hood, we're going to use smart contract to add a certain amount of rules, allowing the money to get smarter.
Mhm. Okay, that's interesting. You think that banks and central banks will only issue the CBDCs and then private companies stick to stable coins, or do you think that banks and central banks will be also involved in stable coin activities?
So I think central bank, because their primary objective is to handle the monetary policy, we should do so using CBDC, right? This is, in theory, at least the way it should work. From a commercial bank perspective, so today, stablecoins are issued by private companies who will issue a digital version of fiat, and when they deposit fiat, they deposit the fiat to the bank, right? So retail banks or commercial banks are already involved in the overall stablecoin value chain, because they are the custodian of the deposit deposited by private companies. We see that some of the banks are currently involved in issuing their own stablecoin. So we see that today. Let's see in the future, because again, this is always the complexity about generalizing use cases that are present, because again, the industry is still maturing. So we can imagine that either banks will just play the custodial role, allowing other payment company to deposit fiat currencies at the bank, and then payment companies or private companies will just issue the stablecoin, or because competitive landscape, which is good, banks will also be involved in issuing their own stablecoin. We see it today, so that might be also the case in the future.
And why do you think stablecoins are a thing now? It looks like that even a year ago, okay, we acknowledge that there are stablecoins, fine, but somehow today it looks like that every financial institution is focused, and the main thing on the roadmap is applying stablecoin backed operations, stablecoin enabled international transactions. Why now? And why not a year ago? What happened? Is it the regulation which gave opportunity to these companies? Is the mass adoption reached a point when financial institutions realized that, oh, actually it's a good thing? What's the reason that they are so trendy now, but they were just not there even a year ago?
Yeah, I think there are some conjunctural and structural reasons, right? The conjunctural one are that it's really the regulation, in my opinion. I think MiCA and now in the US, the Genius Act, because of regulation and because stablecoins are part of a clear regulatory framework, you will be able to welcome financial institutions to enter the market. Without the regulatory frameworks, no financial institution will never enter the market, simply because it's too risky. So banks will never enter a non-regulated market, especially on the payment side, right? So for me, this is one of the main criteria. And it is good because we needed this regulatory frameworks. Again, in the past, the majority of the stablecoin projects failed. algorithmic stablecoin. And then there are also some structural reasons. The structural reason, and everybody is talking about stablecoin because this is primarily what this technology is about. Originally, the blockchain technology is about payments. It's written in the Bitcoin white paper. It's a digital cash payment system. So it's about bringing digital native payment capabilities, and that's why because of stablecoin are issued by private companies, and private companies are able to innovate. Because when we talk with central banks, we tell them that the central bank should not be very innovative because that's not their primary focus. Their primary focus is to control the monetary policy. So let the private sector innovate, and then you can also observe how the private sector innovate to regulate and to make sure that you create a regulatory framework. That's what they've done, not the central bank themselves, but the regulatory bodies around the world. For all these years, they observed the markets, and based on the market, they created these regulatory frameworks that today allow stablecoin to be adopted. That's why also there have been a lot of activity within the stablecoin space during the last months. And obviously, we have a lot of other stakeholders involved in the stablecoin space, and so on and so on. And as we mentioned earlier, banks are also involved, but these have been allowed because of a clear regulatory framework.
So, is there something that we missed out and you feel that you want to talk about, to raise awareness about? Is there something that I should have asked, but we didn't?
I think the blockchain technology still misses is ChatGPT moment, right? Still missing the killing app that will allow everyone to understand. Okay, that's the technology is about, right? And if we take AI, is the same. Right? AI is not new; it has been invented during the last centuries. The first scientific papers last for a while now, and it has been just adopted last year. So blockchain is quite new as a technology, so it's normal that it's not fully adopted yet because it takes time for technology to be adopted. So for me, stablecoins have the ability to be the ChatGPT of blockchain because people will understand directly. Because we still miss that. We still miss the killing app that will allow people to understand the capabilities of the technology. And when you're going to be able to have loyalty programs directly embedded into money without relying on specific loyalty programs, when you're going to be able to pay on WhatsApp using a stablecoin, and you set up some rules, and you can pay using a text, and you can mention that you can send on WhatsApp, I send you $2 from my bank account, and it will send money from your bank account, you will understand directly the capabilities of blockchain. And I think stablecoins, they have this ability because first, that was this technology was about payments, and stablecoin is just the natural evolution of the original vision of the technology. And I think that's what this industry misses, and that's why stablecoin should be able to represent these ChatGPT capabilities.
Wow, thank you so much, Thomas. I learned so much. I thought that I know about stable coins, but there were so many aspects that even for me were completely new. So thank you so much for coming here and educating us about all of these little details. As I said at the beginning, I would like to encourage everyone that please share your comments, experience, questions, anything that you think that could add further to the conversation, because that's the whole point, to talk about the different areas, to encourage innovations, to clear out all of those blurry parts which are not really clear. There's no question which is stupid. That means that, we need to talk about certain parts more. So please, everyone, just reach out to us here at the Soltesz Institute or to Thomas. You can see the email address on the screen. If you have any further questions, I'm sure that we are very happy to reply to any of those comments and questions. And thank you again, Thomas, for being here with us today. I think it was an absolute pleasure, and really, really looking forward to talk to you guys.
Thank you very much for having me.
Thank you.
Bye-bye.
Hey, welcome everybody. I'm Marcia Klingensmith. Instant payments is transforming the way money moves all across the globe, across all the different industries. A recent study showed that 42% of instant payment transactions actually happen on the evenings and weekends. About $200 billion is currently locked up in the European financial system today. And instant payments really can help unlock this liquidity. The future of finance is instant, and those who adapt will thrive.